This is Cece back with you. Today I wanted to go over the wheel strategy, detail some of its positives, highlight some of its negatives, and offer up a couple of alternatives, a wheel strategy 2.0. Let's begin with a description of what the wheel strategy is. The wheel strategy is a strategy that combines cash secured puts, stock, and covered calls. And the way that that works is a trader chooses a stock. Let's look at the QQQs in this example. And what they do is they sell cash secured puts down below where the stock is trading at a level where they would be comfortable being put the stock. And what they would then do is if the stock does not decline to that level in that time frame, in this example, let's just use 30 days, they would collect the income on that cash secured put. If the stock did decline down below that level, they would be happy to be assigned that stock, and then they would immediately turn around. If the stock declined down below this put at expiry, they would be assigned, and then they would look to begin to create income against that long stock by then selling calls to the upside against that stock, covered calls. And the idea here is that they have basically bought low, sold high, and created income potentially with the premium received by the cash secured puts and then the covered calls. If the stock were to increase in value and go through the covered call level, the trader would have made money both on the initial premium sold on the cash secured put, the initial premium sold on the covered call, and the fact that they had bought the stock lower and it had gone higher before they got called away. So those are the positives. It's taking advantage of a couple of things that all traders should be aware of, which is selling premium for income, being bullish, long delta, and buying low and selling high. So it has a ton of positives. Now, where traders sometimes run into problems with the wheel strategy, or they've had negative experiences with the wheel strategy, it tends to be one of two things, and particularly on the bearish side. It's they sell a cash secured put, the stock declines, but the stock declines way more than this 3.8% expected move in this case. And let's say the stock goes down 15%. So now all of a sudden, they were willing to buy the stock down 4%, but they've already bought it at that level, less the premium received. But that's essentially their cost basis. And the stock declines further, and they're now in the hole from having bought the stock higher. And then they're attempting to rescue the position by selling covered calls. But in some cases, those covered calls may be so low where you might even be getting called away lower than your cost basis. So a lot of times if you get really in the hole on a steep decline below your cash secured put, you can be in a hole that's tough to get out of. On the flip side, and this is less of a negative as far as losing money, but it's sometimes a situation where you've missed out on a bunch of opportunity. Let's say you were put the stock and it was sort of perfectly played, and then the stock immediately starts to rally and you start to sell covered calls. Well, if your covered calls are, say, 4% higher in the stock, and then the stock rallies 15%, you haven't lost money because you've made the money between that cash secured put and the covered call level, plus the premium you've received. But you've missed out on all of those gains higher in the stock. So the question here is, can we mimic some of the good things about the wheel strategy while reducing the risk and the collateral required and some of the negative consequences when things go wrong in the wheel strategy? And can that be done using spreads? Let's use AMD as an example, as if we were just starting a wheel strategy. Let's use a 1-month time frame using the expected move chart that puts the level at about 88.5 in the stock. The stock is currently trading around 97, so about $9 lower in the stock. And let's assume that we would be willing buyers at that level in AMD. So as we see here, we've got a selling the 90 put but covering that put by buying the 85 put, creating a $5 wide credit put spread starting at the 90 level with a break even at around 89. So the benefits of this, first off, are the collateral required. So if we were selling the 89 or the 90 put as a cash secured put, that would require somewhere around $9,000 in collateral. In this example, we are risking $400, and we would need $400 of collateral to put on this credit put spread. Now we are selling the 90 put at around $2. So if we were doing that outright as a cash secured put, we would be potentially collecting $2. And in this case, we have to buy the 85 put at around $1. And so therefore, we're only collecting $1. However, you can change the size on this because the goal here isn't to match the contract size we're willing to be put. What we're doing is looking at this in dollar terms. So let's go and change this to 2 times, right? So now we've matched our cash secured put, what we would have received by just making this a 2 contract size put spread. We are now risking $800 to potentially collect $200. So our collateral is $800, but again, this is a lot less than the $9,000 that would be required for a cash secured put. If AMD stock was to decline below 90, and let's say remained between the 90 and 85 put strike, then we could think of this just like a cash secured put, potentially be assigned on the 90 put, and it would be working exactly like the original wheel strategy. Now the benefit here, besides the collateral aspect, is what if AMD did decline a lot more than this? And let's say it went down to 75. We have protected ourselves against falling into that hole that was previously described by protecting ourselves with that 85 put. AMD could go down forever through that 85 put, and we have defined our risk, and we don't find ourselves in that hole. And if it did go down, let's say the stock went to 75, we have a choice at that point to potentially just step in and buy the stock or continue to do a credit put spread with defined risk as it goes lower in an attempt to create that first collection of premium before the stock were to rally back. So let's fast forward a little bit and say the stock did decline down towards our credit put spread. And at that point, we had the choice. Either we were assigned the stock because the stock was in between our strikes, or we decided to close that credit put spread and simply buy shares of stock. And we could have done that near our credit put spread, below our credit put spread, or within our credit put spread. Now the key here to the Wheel 2.0 strategy is we are not beholden to the 1 to 100 ratio of options to shares. We can buy however many shares we want to buy, and we can think about it in dollar terms. How much of this stock do we want to own? And that is important because of what comes next. So in a traditional wheel strategy, we are put the stock, and let's say we are now long 100 shares of stock. We then begin a covered call strategy where we have to sell 1 call to our 100 shares. But in this scenario, we are going to do credit call spreads. And with the same philosophy as the original credit put spread, it gives us flexibility. And in this case, we're looking at the dollar amount of this credit call spread versus our dollar holding. It could be 10 shares, it could be 50 shares, it could be 175 shares. But what we're looking at is we own $9,000 worth of stock that is now worth $9,800. How much income are we looking to collect on the upside of this stock as the covered call part of this strategy? And therefore, how much in opportunity cost are we willing to risk if the stock rips higher through that credit call spread? And so we can look, by changing this ratio, we can sort of think about this in dollar terms. Do we want to collect $75? Do we want to collect $125? Do we want to collect $250? And what we're looking at is the max risk number of this spread. And it should be easy math. and it should be compared to how many shares you own, what those shares are worth, and what they would be worth at these levels. And if the stock did go up through the credit call spread, how much of that upside am I willing to give up? And this lesson is true of all strategies where you're replacing a covered call or a cash secured put with a credit spread. It allows a trader to be more flexible with their strategies while also not getting caught in very tough situations where a stock declines very far through a cash secured put, or the stock accelerates through a covered call and you miss out on a lot of the upside.